back in time, let's go back a little bit to our search summary question that came in from Bob regarding search summary tool. And we scrolled down, we added the married puts and we scrolled down. James says, on the married put search summary, you're showing puts that are only 14 days out, but every other version I've seen you discuss, your puts are 7, 8, 10 months out in time. That's correct. That is another thing I have to look at here. I don't know why that's not set the way it should be. This should be mirroring our preferred approach for a married put position following the rules in the blueprint, where to put the 3 core principles of the married put structure on our side, we want to be going at least 150, 180 days out in time. We want to go slightly in the money for the controlled risk and also to avoid the ATM bell curve, where we want to sell at the peak of the at-the-money bell curve, not be buying at the peak of the ATM bell curve. But we don't want to go more than 20% in the money. I think we covered that last week, but I'm going to show it again, the pros and cons of going quote-unquote too deep in the money. So that's the basic structure that we put the 3 core principles in our favor. Proper position sizing, the red line, radioactive decay line, time decay curve, essentially. We don't want to buy things that are only 10 or 14 days out in time because the rapid time decay. We want to be further out for that slower time decay, and the at-the-money bell curve. And of course, the basic criteria that we use when we open our married put positions, you can see right here, radioactive sorting by earnings per share growth, looking for puts at least 150 days out in time, controlled risk between 3.5% to 9.5%, not going more than 20% in the money. And then we have our technicals that we're using. I always up mine personally. You can make changes to this as you need. Okay, this is just a basic guidelines of our starting point, but I change mine too. In fact, let me go back here. I'm only going to use a, still kind of, no, we're not that volatile. I'm going to go 7.5% as my max risk in this screen here. And I'll change the default to look for a little bit higher average stock volume. Fundamentals, I don't know your account. I know my account, and in general, I'm probably not going with stocks higher than $85 or $95 because I'm buying the underlying security, not on margin. And pretty much that's about it. Sometimes I'll put in a MACD. I want to see the MACD recently, if there's any. Let's just run this search first. We had 31 results. Good. I'm going to narrow it down to 8. And graphic packaging holding is one we talked about a couple weeks ago. BJ's, I was curious about. I saw that one come up on my search the other day. And I can't remember what Funko was back in the search the other day too. I was comparing those two for a new potential position in that case. So those are what the criteria look for. This is the preferred criteria. Yes, in the search summary, it should reflect that. It's just showing a week out series. To the point of, is there such a thing as too deep in the money? Why are we limiting it to less than 20% in the money? Well, the married put structure, we want to have a good controlled risk. You see that here, 6%. Most we could lose, and that's the worst case scenario if the stock's trading, the stock's trading below 30, all the way out to January expiration. We held the position all the way out to January, made no adjustments, didn't accept any dividends. Most we could lose is 6.2%, or the stock falls 35 or 40%. That's the most we could lose in that catastrophic event. But let's go now to the search by symbol tool from the search, and it'll show us all the positions in that expiration for adapt health, excuse me. So that's good. That's right in my wheelhouse. A good 17% in the money. You know, it's a $25 stock and it only offers 5-point strike differences. So I should have maybe used a different example. We will do another one. But the lowest risk here is a great 1.5% risk with the January 45 put. It has a higher price, but most of that is intrinsic value. The maximum risk that we're seeing is just the time value. And that's emphasizing what? The at-the-money bell curve, where the options that are at the money, the 25 strike, has the highest time premium, not the highest risk, but the highest time value. About 318 here, because it's right at the money, okay, 268. Because the stock's at 25.50. In the case of the puts, as we go deeper in the money, we get a much lower time value, which is the true risk. We're paying a much higher price because of higher intrinsic value. It's deeper in the money. And down here, we have a lower time value, but we have the highest risk because the stock needs to fall 31% down to 17.5 before the insurance policy kicks in for us. Yes, it's going to be gaining in value as the stock falls because we're not right at expiration. And it's going to be moving to at the money, so you're going to see a time value swell in that case. But you don't really start getting the protection, so the maximum risk is 37% versus 6% at the right structure. Well, what's wrong with the 1.5%? Is it always better to take a lower risk? No, because it's so deep in the money. We're 76% in the money. That means we have a much lower expectancy of expected profit, meaning we need the stock to move a lot more before we start seeing a reasonable profit on this position. The put has a delta of 0.93. So at the beginning, for every dollar the stock moves up, we're losing 93 cents on the put. We want to be here, 0.55, 0.6, 0.65, under 20% of the money with a good risk of about 4 to 7%. That's the good structure. For me, this is the structure I would choose on this position. The 3.6 is too deep in the money. But now comes the question. What am I going to do with a married put position? Well, I'm going to put on the married put position. This is not a recommendation or suggestion. I'm not going into Adapt Health next week. Just to make that clear, we're just using an example. I mentioned the two that I was looking at from the search earlier this week. But I'm entering in a bullish position. I have a bullish expectancy on this stock that it's going to move up hopefully 3 to 6% or so in the next 30 to 40 days, 30 to 50 days or so in the first month. And that's when I'm going to look to apply the income method. So the stock moves up. We've got the 30 strike put. The stock moves up from 25 to, let's say, 27.50. That might be a good time to sell the 30 call, get some premium, and lower the initial at risk. Those are the income methods that I could use. And there's different income methods I could use if the stock meets my expectations. What is the premium right now? And this is why I said I should maybe use a different one. It's only 30 cents there. Let's go to September. Midpoint's about 50 cents or so, 60 cents. So that's good. On a $25 stock, a little bit more than 2%. So if I sold the September 30 call now, and again, I wouldn't. I would wait for the stock to move up to get a better premium following the guidelines in the blueprint for this particular income method. But yes, I reduced the risk down to 3.3%. And the max return is 7.4% if the stock's trading right at the short call strike price at expiration. No guarantee I'm going to get that midpoint with that wide of a spread. Okay? So that's the basic structure. That's the plan. I'm going to continue to do income methods to lower the risk to where I can potentially bulletproof a position and have no risk on the trade, and still lowering my cost basis to get income. This is just one of the 12 income methods. But we see the premiums at 58 cents. That's more than 1.5% that we would have if we went with that deep in the money 45 put, isn't it? I could be bulletproof right away. This is a no-no, and this is why it's important to have the blueprint. We go to January, we buy that 45 put, and at midpoint, we saw our risk of, actually, it's going to be lower than that. Oh, at midpoint, it's bulletproof. So you know that's not realistic. Let's put in $20. We're not going to get $19.50 for that. We're going to pay at least $20. Oh yeah, so there's our 1.1, 1.5% risk, a risk of 50 cents. Midpoint on the call, if we get it, was 58 cents. Wouldn't that negate all of the risk in this married put position? The answer is yes, to the downside. What is my cost basis on this trade? $25.50 for the stock, $20 for the put, for a total investment of $45.50. What do I do when I sell any call in a covered call position? Just as a general call itself, I'm going to obligate myself to potentially deliver shares of stock at 30. How did the risk go up to 33.2% if I've bulletproofed the trade for $8? Because we increased the risk to the upside, because our cost basis is still $44.92. What happens when the stock breaches our 30 strike call? Now, I'm not saying AHCO is going to gap up to $32 or $34, but is this the graph you want for a position that you initially entered because you thought the position could rise 3 to 5% in the next 20 to 40 days? Absolutely not. Now, you can gamble and say, I think it's going to be below 30, and after this call expires, I'll have a bulletproof position. Again, we're not getting those midpoints here. So just ignore that for now. But if something unexpected happens and the stock moves up here, the put is declining in value naturally as the stock's moving up. Our original married put had a positive delta as a bullish structure because we have delta of 1 on the stock, and delta I think we saw of 0.61 on the initial put that I preferred, or 0.93 on this put we're looking at here. Of course, that's ever going to be changing as the stock keeps increasing. Gamma is going to be taking that down for us. But the put's still losing in value, but we no longer have a 1 positive delta on the stock. That's being negated by the -1 delta of the call that we sold. Because we sold it, it's a negative delta. So now we get no more positive upside. Our risk is to the upside in the direction we thought we wanted the stock to go. So that's another no-no of income method number 1. I don't really want to sell it right away. I want to wait for the stock to move in my desired direction. I prefer to get at least, and in this case, yeah, it was, but you prefer to at least get a third of the maximum risk by the call premium, so it's better to wait for the stock to move up to do that. But do you want to create a bearish structure, even though you're confident that the stock's going to stay below 30 in the next 42 days, to where you then have a bulletproof position on from September to January? It's kind of a risk, and then your put's still up at 45, still with an extremely high delta because the stock, if you guessed right, is still trading at 28. So you're going to have to keep selling these lower strike calls because the stock's trading nowhere near we'd need at $45 per share to start to get the benefit of the ATM bell curve on the put. It's going to just have mostly no time value left that you've already paid for. I get it. But selling calls against it continuously is still going to put you in this structure, which is actually bearish as opposed to bullish. Now, I know that sounds like a lot of information there just to sell a call against a married put structure, but of course, that's why the blueprint is there. The blueprint is there to teach you all the ins and outs of the 12 different income methods, when to use them, how to use them, how not to use them to stay out of trouble. I had a coaching session with a gentleman who had a stock trading at $79, and his call was sold at 70. He had just rolled to it, and it jumped up 3 days in a row from positive earnings, and then 2 days after, still interest in the stock after the earnings. And the put was currently at a lower strike, which was good. But he said, what if I just rolled up to the 85 strike put now? And that's also a no-no. What I never do is, sorry, folks, if I'm in a position, well, a different position, what you never want to do is put yourself in this position by, let's say I had the 25 put and I sold the 30 call. Now the stock is up, I want to move the put. I don't want to roll to a 35 put where I create this structure. And you want to move the call first. That's what's going to be hurting the position the most as the stock moves up, because its delta against you is going closer to 1 and the put is declining. But this is negating more of the possible growth on the position as it's going deeper in the money, and its delta is getting closer to -1. Okay. So I just wanted to review that real quick. And again, remember, best protection, 12 income methods to lower the initial at risk, generate income, potentially bulletproof the trade. That's what's in the blueprint product there, of course. It's $349, and it's all electronic access. It's all electronic. We don't send hard copies anymore. You'll get an account at our educational portal, learn.powerop.com, where you can go through the electronic version of the blueprint. Of course, you have access to myself and Ernie coaching sessions as well as a blueprint owner, as you do as a PowerOptions subscriber as well. Okay. So that's just some of the review on some of the why the married put is not right in the search summary. You'd want to look more for use a married put on a stock you own. You just want to go to the married put, go to search by symbol, and select your preferred expiration date, and then you'll probably see better structures there that better match the better approach for the married put.